Welcome to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm talking to you from, today I'm talking to you from Queens, actually, the borough of Queens. Last week I was in Cascais, Portugal, had a wonderful time there. But today is the 13th day of September, and I'm back in the borough of Queens, New York City. Before I talk to you more about today's show, I do like to remind you I publish a newsletter that focuses largely on junior exploration, gold and silver exploration companies. We also hit on some exciting energy stocks as well, and a few other things from time to time. A couple of biotechs that Chen Lin follows that we really love and are very exciting stories as well. And speaking of Chen Lin, I would like to encourage you to consider signing up for his letter, What is Chen Buying, What is Chen Selling? You can do that by going to chenpicks.com, chenpicks.com. And also like to remind you of Michael Oliver, who will be with me shortly. His wonderful newsletter, Momentum and Structural Analysis. Go to olivermsa.com to sign up for Michael's letter. Do want to thank you for listening to this show and making it one of the more popular shows in the Voice America Business Channel. Also like to encourage you to continue sending along whatever questions, whatever comments you have about this show. Send them along to questionsfortaylor@gmail.com. Questions, the number 4, Taylor@gmail.com. And, of course, we want to thank our sponsors. This week's sponsors, Irving Resources, Noble Resources, El Oro Resources, Reyna Gold Corp, Timberline Resources, and Lion One Metals. I've titled today's show, Supply Chain Disruptions and Inflation, or Deflation. John Rubino, Patrick Highsmith, and Michael Oliver are this week's guests. After the fall of the Soviet Union, the world engaged in global trade on a scale never seen before in world history. The U.S. entered into this new era by offshoring major industries, offshoring those jobs, those high-paying jobs, value-added jobs offshore. And while that benefited corporations with low-priced labor, it not only devastated America's middle class, but it also made America extremely vulnerable to China, which now produces life-sustaining products that America no longer produces, such as antibiotics and key materials used in industry. America employed fiat dollars, that is, dollars backed by nothing, that were accepted globally, largely because of our military force and certain diplomatic arrangements that were made with Saudi Arabia to require oil be priced in U.S. dollars. But along the way, nations like Russia and China took note of America's global expansionism, funded with an intrinsically worthless dollar. And Russia, in particular, became angry with America and NATO, which dishonored its pledge not to add one single inch of new territory into NATO after the Soviet Union fell. The talk of adding the Ukraine into NATO was a line in the sand for Putin, who responded by invading the Ukraine. It was just a line too far. It was just pushing the envelope a little too far. So sanctions against Russia gave Putin no choice, from his perspective, but to cease selling energy to Europe unless sanctions were removed or energy was paid for in Russian rubles or gold. Even at a time when hyperinflation is becoming a real possibility, a growing number of European nations are planning to print enough money to pay for high energy prices thanks to green energy policies and sanctions. The European Union, and especially certain countries there, are in big trouble without energy supplies to keep them warm in the winter and to keep their industries humming. So Putin is playing hardball with the West and a desire to get the U.S. And NATO out of Europe. And to the West, and in particular Europe, will have to accept, I believe, a currency that is based on tangible assets like the ruble to buy its energy. Have to depend on those tangibles backing the currency, unlike the U.S. dollar, which has nothing behind it, gold or energy in the case of the ruble, or face an economic depression, either of hyperinflation or a deflationary depression. Time will tell. We hope something is resolved there, but whatever the case is, it would seem as though Europe in particular and the West in general is in big trouble economically. So if the West refuses to play ball with Putin, I think the only question is whether whether this whole situation will be resolved in a hyperinflationary or a deflationary depression. I could be wrong, but that's the way I see it. Well, we'll discuss what all this means with John Rubino in the second half of today's show. Then in the second segment of today's show, Patrick Highsmith will update us on Timberline Resources. It's a company that has discovered a Carlin-style high-grade gold deposit in Nevada, and we're expecting some good news from that company. So Patrick will be with me in the second segment of today's show. But right now I'm happy to tell you that Michael Oliver is with me once again to give us his latest thoughts on these very challenging markets. Welcome, Michael. Thanks for joining me again.
Good to be back.
Always good to be back. And I know in your weekly letter this weekend, on your precious metals letter, you talked a great deal about silver. And it seemed to me that silver might have broken through the levels that are sort of key for the next rise, the next major run higher. What can you tell us about silver, and why is this really the key precious metal in your point of view?
Well, it's obviously gold's the mama, so what it does will influence silver. But there are times when you should watch the silver-gold spread, the price measured versus the other price. And, of course, silver's been losing value relative to gold on a per-ounce basis since January of 2021. That was the point where silver reached $30 for a second time. It had reached it in the summer of 2020 and again in January 2021. Ever since then, the spread between silver and gold has deteriorated. Not collapsed, just gone down in arm wrestling manner for, a year and 3 quarters now almost. We measure things not by price so much as the momentum of price. In the case of a spread, it is price. It's one price versus another. So it's really a price chart, okay? We study its momentum, and we've been watching a momentum structure that's developed on that spread for quite a few months now. It's a year and a half wide. In other words, if you looked at the spread chart, you see this declining staircase. But when you look at the momentum chart, you see a ceiling at a very shallow level that we bumped 3 prior times. We're now about to bump it a 4th time. I think we're going to break out this time if we close. It wouldn't take a lot more this week in terms of the shift in that spread to break it out. Meaning, at that point, MSA is going to say, this metric, which we regard as very important, a weighty metric, it says the net trend of both metals is going back up. Because when this spread shifts direction, favoring silver or disfavoring silver, it usually means price of silver and gold are rising, when silver is beating gold. In the case of when silver is losing versus gold, it means price is usually declining, which, of course, is what's been happening for the last year or so. The funny thing here, though, I'm really intrigued by this. It's not that silver rallied $2.50 off the low of the month as of yesterday's high. Right now it's $2 off the low of the month, up at 1950 area. While that occurred, gold labored still in the lower part of the 1700s. Like, it didn't even know what's going on with silver. It didn't give it any encouragement. Silver did it on its own, which I find very intriguing because I think it's very important it do that. But when you look at a gold chart, just a price chart, a stupid, simple price chart, you've been in a range for 2 years. Since the 2020 high, we got up to $2,070. We dropped back in March of 2021 to a low of $1,673. Okay, March low of last year. August of last year, after the Fed said in June they were going to raise rates, gold went back down into the 1670s, held the March low, and rallied sharply. July of this year went back down again to 1680 and rallied again back to about 1770 or something. And today we traded to 1690 something again. If I were a bear, and apparently according to the CFTC, the institutional positions in gold and silver have shifted to their least bearish position in a long time. Normally they're sort of weighted to the bear side. Now it's the small specs that are heavily short. If I were a small spec, heavily short, especially if I had time-determined puts, cooking away, how come gold can't blow out that silly, obvious low? It's been used, and it's a weird-looking chart. It looks like it needs to be broken through to either suck more shorts into the market and then turn up, bear trap them, which I think it will do, or it simply doesn't go through those lows. And every time we get down here, I'm almost sort of cheering privately for, let's go take out those lows, explore what's down there, which I think is going to be buying. Okay, but they can't even do that. Now here we've got, if you're short, you've got three reasons to be short gold. One, the dollar is so strong. Actually, since the May breakout, when it took out the range highs of the last 7 years, the dollar's up 5%. Big deal. 6 months, up 5%. Two, the Fed, you can't fight the Fed, they think. Okay, well, therefore, gold's got to go down, right? Okay. Three, when the stock market's weak, oh, golly, gold will go with it. Three prominent, widely held assumptions, and yet gold still hasn't broken through the silly low of the last 2 years. And gold's down right now 6% on the year, while the S&P's down high double digits. Nasdaq's down a lot more double digits. T-bonds are down double digits. Muni bonds are down. You know, everything in a normal portfolio is getting killed to the tune of double-digit percents, and gold's down single-digit percents and can't seem to break through. What's going on here?
I don't know. Tell us.
That's the question that nobody's asking. I think what it is big money, big funds are accumulating gold because I think they know there's a point at which, and economist Jerry Epstein today, I saw him on TV, Jeremy Siegel, from Wharton School, said the Fed may be going too far here, which is jeopardizing these other assets. He's not alone in that. We've been saying it since early in the year, but now there's a lot of economists out there saying, hey, the Fed may be going too far. In which case, there's maybe a point here where the stock market breaks through certain levels that alarms the Fed. And certain other factors come into play, maybe in Europe, maybe here, that cause the Fed and other central banks to rethink the whole thing. That, the wrong thing is being deflated.
Yeah.
The inflationary stock bubble, not the commodity. Bloomberg's up 20% on the year.
Yeah.
That says, index.
Well, Michael, usually that's what the Fed does. On these tightening situations, they tighten until they break something.
Well,
and
they create
then the
bust cycles.
Yeah. And then the bust. And then they got to come back in and start pumping money into the system again.
Only this time the bust is far bigger than any bust they've ever seen because we're
that's right. That's right. And which leads me to a discussion we'll have with John Rubino, I think, later today, and also Alistair McLeod next week. And that is the idea that we may have some sort of a reset, some sort of a major monetary restructuring. You know, a Bretton Woods in Asia and Bretton Woods, Alistair is suggesting. So. Very interesting times.
Reserve currency, you know.
Yeah, well, they're building up their gold reserves like mad. Those two, Russia and China, and a lot of other countries that are not NATO-friendly countries are building up their gold reserves very dramatically. Just real quickly here on a couple of the other commodities. Well, first let me ask you. So, do you think we need to see the equity market break down? That will be the thing that really helps gold. Then finally,
I think that is a spark. Now, gold might temporarily want to participate. You know, I keep expecting that because I know there's a mob rule out there that thinks it's inevitable it must, which is false.
Yeah.
It's also false that you can't fight the Fed. Fed funds rate went from 4% to 14%, all prior to when Volcker came in. Gold had gone from $100 up to about $800 before Volcker even came into office. And rates had gone from 4% Fed funds to 14%, and gold had a bull market all during that time. So remember that. You can fight the Fed sometimes. And I think this is one of those times. So I think maybe the stock market is the spark which will fool people because they'll expect gold to collapse if the stocks go down. And I think it could be the spark that really injects fire into gold on the upside.
So that may take us down there, as you say, to see what's below that 1690 level. Let's see what's down there. Okay. All right. Just real quickly, I saw you put something out, rice. Is rice and commodities, agricultural commodities?
Rice they trade the futures, and it's pushing it. It's all-time highs. In fact, it made these price highs that it's currently at a decade or so ago, and then several years ago, and then now it's clustered at these all-time highs. So unlike some of the other grains, which had pretty good corrections, and now I think are ready to reassert themselves to the upside, like corn, wheat, and beans, rice never did really correct. It just sitting there crowded at all-time highs. And rice, of course, is 3.5 billion people. It's an essential.
Right. So, for sure. Yeah, absolutely. Well, it's okay. And oil and gas, especially natural gas.
I think gas is the one to watch, not gasoline, but natural gas.
Natural gas. Okay.
We still expect maybe it can go up 50% from here, meaning up in the teens. That would be very crippling in the winter, you know.
Oh my goodness, would it ever? Okay, well, hope in a way I hope not, even though I have a vested interest in owning a few shares of a natural gas company. Anyway, Michael, thank you so much for your insights. Always great to have you, and thank you. We'll look to have you again in a couple of weeks.